If you're sitting on millions of XRP or any other crypto, you likely understand that selling triggers short-term or long-term capital gains and means losing exposure. So if the price shoots up after you sell, you're left watching from the sidelines. Now, there's a better play, and that's through crypto lending or crypto loans. So in today's video, I'm going to be breaking down how crypto loans work and may allow you to borrow against your XRP and other crypto assets that you hold while maintaining ownership and upside exposure. So we're going to dive deep in this one today. I'm going to be showing you the exact platforms, walk through real examples with actual numbers, and give you strategies that most people do not know about. And by the end of this video, you'll have everything that you need to safely unlock tens of millions of dollars from your XRP portfolio. And if you're brand new and you're just getting started, hang to the end. I'll also share strategies with you to be able to grow your portfolio if you don't have at least $1 million in net worth in the crypto space. Now, a crypto loan is straightforward. You deposit your XRP as collateral into a platform. Your XRP is locked up, and in exchange, you get a loan, usually in a stablecoin like USDT, USDC, or fiat currency like the US dollar. You don't sell your XRP, you still own it, it's just being held as security. Think of it like using your house as collateral for a home equity loan, except instead of your house, it's your XRP. But here's where it gets really interesting. Unlike traditional loans where banks check your credit score, employment history, and debt to income ratio, crypto loans focus solely on your collateral. So let's say you sell $25 million worth of XRP to access cash. Now you potentially face two major issues there: massive capital gains tax and missed gains if XRP pumps after you exit. So with crypto loans, you may avoid both. Now, an important disclaimer here before we continue the rest of this video: I'm not a financial advisor, tax advisor, or attorney. This content is purely for educational and informational purposes only, and tax laws, they're very complex and they vary depending on jurisdiction, depending on country and individual circumstances. We have tens of thousands of people watching our videos each and every single day, so always consult with a qualified tax professional before making any financial decisions, because I understand that there's people from all countries, all walks of life, all income levels, and according to the IRS in the United States, on their publication 525, the official IRS guide on taxable and non-taxable income, it states that borrowed money is generally not considered taxable income when received. However, your specific tax situation depends on various factors and your jurisdiction. So for personalized tax guidance on your specific situation, consult with a qualified tax professional. And we actually have a qualified tax professional and certified CPAs inside of Altcoin Pro University. You can check that out through the link below if you need tax guidance. Now here's a real example to show you the power of crypto lending. Let me walk you through a hypothetical scenario. Let's say someone bought back in 2024 for about $5 million when XRP was at 50 cents. Now fast forward to today, at the time of making this video, that position is worth north of $30 million as XRP sits just above $3. So if they need $15 million for a major commercial real estate acquisition, if they were to sell XRP to get that cash, they might face significant capital gains taxes on the $25 million gain. And depending on what state that they live in, whether they live in like Florida, Texas, or let's say California, their taxes are going to vary. That's why consulting a tax professional is critical for your specific situation. But instead of selling their XRP, they could potentially take out a crypto loan against it and deposit their XRP as collateral and borrow $15 million with some interest. Now, their annual interest cost could potentially be less than the capital gains they would have to pay if they had sold the $15 million. And just understand this example is illustrative purposes only, obviously not tax advice here. But let's talk about the raw numbers here. Crypto loans use something called loan to value, or LTV. This is the percentage of your XRP's value that you can borrow against. And with XRP, most platforms offer anywhere between 15 to 75% LTV. So if you've got, let's say, $100 million in XRP, I know that might seem like a big number, but that's actually very small compared to some of the clients that we work with that have billions of dollars in XRP. So 100 million, very, very small number compared to how much money is realistically out there. Well, depending on the platform that you choose, if you get up to 75%, well, that's 75 million LTV. And depending on your risk tolerance and company that you go through, which I'll give you options by the end of this video if you hang tight and you keep watching, that also offer non-recourse loans. Well, lower LTV means a safer loan with more breathing room, and higher LTV gives you more cash up front but carries more liquidation risk. So here's what most people get wrong. They think that a higher LTV is always better because you get more cash, but let me show you why conservative LTV is the actual power move here. Let's say you have $50 million in XRP. You could take a 50% LTV loan and borrow $25 million. But if XRP drops 30%, your collateral is now worth $35 million. Your LTV LTV just jumped from 50% to 71%, and most platforms will liquidate you somewhere between 75 to 85% LTV. So you're dangerously close to losing your entire position. Now, let's say you took a conservative 25% LTV loan instead. You borrow $12.5 million against the same $50 million position in XRP. So if XRP drops 30%, your collateral is worth $35 million, but your LTV only increases to roughly 36%. So you're still in the safe zone with plenty of breathing room. So smart money uses conservative LTV. That way they can sleep well at night. Now, when researching crypto loan platforms for this video, my priority was to find the best options available to help you make an informed decision. So I've carefully evaluated multiple platforms based on their terms, their reliability, their counterparty risk, and user experience to ensure you have access to trustworthy choices. And for full transparency, we may earn a commission if you choose to use one of the platforms mentioned through our referral links. However, this does not influence our recommendations, and we've included a range of options to suit different needs. For example, several leading platforms, including those licensed in the European Union and other jurisdictions, offer flexible repayment terms and loan-to-value ratios up to 50%, allowing you to select which works best for your financial goals. So, as always, do your own research and pay attention to the rest of this video so you understand what you're getting into, because many have tiered systems based on token holdings that can reduce rates. Some allow interest-only payments, which means you can keep rolling your loan indefinitely as long as you're paying the interest. However, their liquidation processes can be aggressive and customer service varies significantly. Whereas other platforms are known for higher LTVs and user-friendly interfaces, they'll go up to 90% LTV on Bitcoin and stablecoins and some other top assets with at least $1 million in daily trading volume. Though with XRP, it's typically 50 to up to 75%. So some offer leverage trading products disguised as loan products. Now you want to be very careful with these. They're not actually loans. They're trading products with liquidation risk. And for pure crypto loans, rates tend to be on the higher side, usually 8 to 12%, because crypto is relatively risky and it's very, very volatile. So even with those high interest rates, there are massive benefits to taking out a crypto loan. So major exchange platforms offer global access with competitive rates, but they have stricter repayment terms. They typically offer about 65% LTV on XRP and rates starting around 7.4%. Now, the advantage is seamless integration with trading platforms, centralized exchanges, but the downside is that these loans often have fixed terms, usually 7, 14, 30, 90, or 180 days, where you can't just roll them indefinitely. There are also specialized platforms that focus on institutional grade security. They offer lower rates and are backed by serious investors, though their asset selection may be more limited and you can't get a loan on some low cap meme coin that you just threw a few $1,000s in and now it's worth $5 or $10 million, unless the daily trading volume is over $1 million. So each platform has its own trade-offs, so always check their interest rates, repayment flexibility, liquidation thresholds, and collateral custody policies before committing to one specifically. So here's a pro tip for those of you that have been weighing different options out there online. Don't put all your eggs in one basket. If you're borrowing a large amount, consider splitting it across multiple lending platforms and family offices. That way, this reduces your counterparty risk and gives you more flexibility across different loan terms, because you understand that no financial tool or lending platform is completely risk-free, even the most legitimate ones. So here's what you need to watch for: the liquidation risk. If XRP drops too far and your LTV spikes above the platform's threshold, your collateral gets sold automatically to cover the loan. Now, in terms of interest costs, these loans typically run 8 to roughly 13% annually, so factor that into your math for the interest rate. And next is custody risk. You're trusting a third party with your XRP, so make sure they're secure, insured, and have a solid reputation, and have already done big deals in the hundreds of millions and billions of dollars. Now, I will give you guys some options to choose from by the end of this video that we have vetted that are the safest options out there that offer the best terms, so hang tight for those. But here's a major tip if you're taking out your first loan. Consider starting with a conservative LTV like 35%, 30%, or even 25%, because this may provide more breathing room if the market experiences insane volatility. Although no LTV ratio eliminates liquidation risk entirely, if the crypto market drops 90% due to black swan events, well then that's just the risk that you're willing to take, but you're in this crypto market anyway, so you understand that risk. And if you have a base understanding of technical analysis and how market cycles work, thanks to the information that you're learning on this channel, then you can mitigate your risk through the knowledge that you already have. But let me tell you about the risk that virtually nobody talks about, and that's opportunity cost risk. So here's what I mean. Let's say you take out a loan at 10% interest rate and XRP goes sideways for 2 years. Well, if you took out a $10 million loan, you're paying about $1 million per year in interest on that loan. And after 2 years, you've paid about $2 million in interest, and your XRP position hasn't grown that the company is holding as collateral. Meanwhile, if you just sold some XRP, paid the taxes resources and invested the remaining cash in, let's say, real estate, some other crypto project, or some high APY DeFi liquidity pool that returns, let's say, 15% annually, you could have seen significant growth while your XRP went sideways. This is why crypto loans work best when you're bullish on your underlying asset and need liquidity for a specific purpose, like accumulating more during an uptrend or diversifying your risk to accumulate more real estate. But you have to have a clear timeline on your goals here. So let me show you how to manage liquidation risk like a pro. First, you'd want to set up price alerts. Most platforms will send you notifications when your LTV approaches dangerous levels, but you don't want to just rely on them. You want to set your own alerts at multiple levels. So if you start with a 30% loan to value, you would want to set your alerts at increments of 5 to 10% ahead of your LTV so you can be prepared during wild swings in the market. Second, it's always smart to enter with a plan. Enter with the end in mind. You want to reverse engineer the process here. When your LTV hits 50%, what are you going to do? Are you going to add more collateral? Are you going to pay down part of the loan? Or are you entering with a non-recourse loan with no intention to pay it back for tax purposes? Third, it's always smart to keep some XRP or stablecoins on the platform. Many platforms allow you to add collateral instantly to reduce your LTV, and having that buffer ready can save you from liquidation during flash crashes. Now, fourth, understand the liquidation process. This is extremely important. Some platforms give you time to add collateral when you hit the liquidation threshold, whereas others liquidate you immediately. So know which type you're dealing with. So let me walk you through some real world scenarios so you can see how this plays out with actual numbers. Scenario number one, the conservative approach. Let's say you have $100 million in XRP. You take a 25% LTV loan, borrowing $25 million at 9% interest. So your annual interest cost is about $2.25 million. XRP would have to drop about 67% before you hit a 75% liquidation threshold. And if you take out this loan before XRP experiences a move to the upside, your liquidation threshold will actually work in your favor when XRP's price goes up. Now, scenario number two is the aggressive approach. You have the same $100 million in XRP, but you take a 50% LTV loan, borrowing $50 million at 11% interest. So let's say your annual interest cost is $5.5 million. XRP only needs to drop 33% before you're in liquidation territory. And this happened multiple times during the 2022 bear market, where you would have been liquidated and lost your entire position. So scenario number three is the ladder strategy. Here's an advanced move, and instead of taking one large loan out with a high LTV, you ladder multiple smaller loans with different LTV ratios. So let's say you take a $10 million loan at 20% LTV, a $7.5 million loan at 30% LTV, and a $5 million loan at 40% LTV. So your total borrowed would be $22.5 million. And if XRP's price drops, you only lose the highest LTV tranches. So your lower LTV loans remain safe. Now, this gives you more granular control over your risk, and it's always smart to diversify rather than just taking out the highest LTV loan that you can get. Now, scenario number four is the refinancing play. So let's say you took out a loan when XRP was at 50 cents, and now it's at $1, a 2x. Or if you take out a loan at $3 and XRP goes to $6. Either way, your collateral has doubled, which means your LTV has dropped in half. So if you started with a 30% LTV, you're now at a 15% LTV. So you can either withdraw some collateral or take out additional loans against the increased value. So this is how the wealthy investors and the billionaires compound their leverage over time. So this is how Michael Saylor accumulates more Bitcoin, by leveraging his Bitcoin holdings to accumulate more as the price of Bitcoin increases. So crypto loans are very effective during bull runs, and this strategy may be suitable for consideration if you're holding a large XRP position and you're still bullish on the long-term growth, depending on when you're watching this video. Because if you want more liquidity while maintaining your position, or you need cash for major investments or expenses and you don't want to experience short-term or long-term capital gains, this may be a strategy worth considering. However, this obviously depends on your financial situation, your risk tolerance, and your goals. And if you have significant crypto or stock holdings, well, crypto loans represent one potential option for accessing liquidity while maintaining exposure, though they're not appropriate for everyone. And to be frank, smaller investors that have less than $1 million just probably won't qualify with most of the platforms, and family offices. So I have to hyper-emphasize this as a disclaimer. This is not a recommendation to use crypto loans. This is purely for educational purposes, because you have to consult with a financial and tax professional to determine what's appropriate for your situation. So if you don't have a CPA, then you can plug in with our professional CPAs inside of Altcoin Pro University. So let me be specific about who should not use crypto loans. You do not want to use crypto loans if you're not comfortable with volatility. If seeing your XRP position drop 30% is going to make you panic and lead to bad decisions, and you're not comfortable with liquidation risk, then stick to traditional financing if you have good credit, obviously. So you don't want to use crypto loans for consumption spending, like taking out a loan against your crypto to buy luxury items or go on a vacation is a recipe for absolute disaster. The smartest move is to use crypto loans for major investments or essential expenses only. So don't use crypto loans if you don't have other sources of income to pay the interest, because remember, you still have substantial monthly or annual interest payments. Unless you're planning on taking out a non-recourse loan and you have no intention of paying it back, which has certain tax benefits. Otherwise, make sure you can cover the annual interest without selling your crypto. You also don't want to take out a crypto loan if you don't understand how to manage your collateral, monitor your LTV ratios, and navigate the platforms. So if technology intimidates you, well, our team can help, but it's good to have a baseline understanding here. Additionally, you don't want to take out crypto loans if you don't fully understand the tax implications for your specific situation. You don't want to enter in blind here. And if you haven't consulted with a tax or financial professional, then don't just rely on your own opinion here or something that you read online, because everyone's different. And if you're not prepared for a potential loss of your collateral, or you're using this as your primary financing strategy without other safeguards, then this might not be right for you. So let me share some advanced strategies that most people don't know about. Strategy number one is the stablecoin yield play. Now, instead of borrowing fiat currency like the US dollar, you would borrow stablecoins like USDC or USDT. You would then deposit those stablecoins into a high yield protocol that would pay you a substantial APY on your income. Now, our team talks about these DeFi liquidity pools inside of Altcoin Pro, so you can feel free to check that out through the link below. So let's just say, for example purposes, if you were to deposit your USDC or USDT into a DeFi liquidity pool that pays roughly 10% APY on your stablecoins, and your loan costs, let's say 9% annual interest, well, you're earning a net 1% APY to access liquidity that you wouldn't normally have just holding spot, while also keeping your XRP exposure. Now, this is a strategy that a lot of our clients are applying, so that way they can keep their exposure, they can access more liquidity, and they can earn yield on the stable coins that they borrow. Now, strategy number two is the tax loss harvesting combo. So let's say you have both winners and losers in your portfolio. You can take crypto loans against your winners to help with short-term or long-term capital gains, while simultaneously selling your losers to harvest tax losses. Now, this could allow you to offset other gains while maintaining your overall crypto exposure. Now, obviously, that's just an example. That's not advice for your tax situation. So I've said this so many times, but go consult your CPA, because these are just examples here. And this is all public information, so you probably already understand this strategy, but this is a good strategy that the wealthiest investors apply. Strategy number three is the dollar cost average refinance, where as your collateral appreciates, your LTV naturally decreases. So if we're in a bull run, your LTV would be decreasing on something like XRP as price continues to go up. So instead of letting that value sit idle, you can periodically take out additional smaller LTV loans to dollar cost average into other investments or even other projects. So this creates a systematic way to diversify your wealth, accumulate more, while also maintaining your core crypto position. Strategy number four is the hedging strategy. If you're worried about short-term volatility, but bullish long-term, you can take out a crypto loan and use part of the proceeds to buy put options on XRP or short XRP futures. Now, this creates a hedge that protects you from downward price movement while allowing you to keep your underlying position. So let me address the questions that I get most often about crypto loans based on this information. So let's say someone's asking, what happens if the platform gets hacked? Well, this is custody risk, and it's very real. So we filtered between platforms that offer insurance on deposited assets. Some platforms have hundreds of millions in insurance coverage. That's why it's always smart to split large positions across multiple platforms, so you're not just putting all your eggs in one basket, because while some platforms have lower risk than others, there's not a single platform that has zero risk. Now, the next question people have is, can I pay off the loan early without penalties? So most platforms allow early repayment without penalties, but if you're doing your own research, you always want to check the terms on this specific question right here, because some have minimum loan durations or prepayment fees. So this is definitely something to write down when doing your research. Now, what if I can't make the interest payments? Great question. If you default on interest payments, most platforms will liquidate enough collateral to cover the missed payment plus some penalties. So this is why it's crucial to have a plan for making payments without selling your crypto and having some income on the front end to be able to deal with the interest on these loans. Now, the next question would be, do these crypto loans affect my credit score? And the answer is no. Crypto loans don't require credit checks and don't report to credit bureaus because they're completely separate from the traditional financial system. That's why if you have bad credit and you go to a bank and the bank hasn't been able to offer you a loan, but you have a lot of crypto that you don't want to sell because you want to maintain your exposure, then this could be a great option for you. So what if XRP gets delisted or banned on exchanges again? Because for those of you that have been following the channel and have paid attention to the Ripple versus the SEC lawsuit, that was a big concern for people. Now, this is regulatory risk. So make sure you understand what happens to your collateral if the underlying asset faces regulatory issues. If you're not dealing with XRP, and most reputable reputable platforms have procedures for handling this, but it's worth asking. It's a very important question. And considering that, XRP is classified as a commodity under the CFTC and the lawsuit versus the SEC is over, XRP holds little risk of delisting now because we've already crossed that bridge. And it's one of the most legitimate cryptocurrencies out there. Now, can I use the loan proceeds to buy more crypto? Well, technically, yes, but this creates leveraged exposure and significantly increases your risk. So only experienced traders should consider this strategy. Because if you accumulate more crypto and your LTV changes and the crypto takes a serious dip, well, then you have to be prepared for that. And you have to understand where the key levels of support at, also where to set your LTV at. And the next question that you may have is, where is the best place to do it and which company offers the best rates with the lowest counterparty risk and the best terms for your specific situation? So what we've done is we've compiled together all of the best companies in this space to filter out the ones that have the best terms for our clients that we deal with that have anywhere between $1 million to $100 million that they're looking to borrow against. So if you have at least $1 million in capital and crypto that you're looking to borrow against, the next step for you would be to reach out to our team and send us an email at team@bullrunners.com. That way we can point you in the right direction and jump on a call with you to answer any questions that you have. So again, that's team@bullrunners.com. You also see that in the description below this video. That way you can reach out because we love to connect with you. Now, if used wisely, crypto loans let you unlock the power of your capital without losing your assets or your upside potential if you were to sell. So you can hold smarter, you can borrow wisely, and you can stay in the game. That's the major key here. The wealthiest real estate investors in the world don't just liquidate their whole portfolios and sit in cash. They borrow against their assets so they can accumulate more real estate. That's what the wealthiest crypto investors in the world do as well too. So if you're a newer investor with $1 to $10 million, well, you're still a small fry compared to the whales that have billions of dollars. So in order to get to that level, this is the next step in your investing journey. But always remember, crypto loans are another tool in your portfolio strategy. They're not a get-rich-quick scheme. They work best when you have a clear purpose for the capital, a plan for managing the risk, and the discipline to stick to conservative LTV ratios. The wealthy use strategies like this to build generational wealth. They don't sell their appreciated assets, they borrow against them. And now that you have the same playbook, if you found this educational video helpful, remember that this information is general in nature. It's not personalized advice. For specific guidance on your situation, you can get connected with our team of CPAs and tax professionals. That way, depending on your specific situation, they can guide you in the right direction. So for me personally, I don't provide financial investment or tax advice. I just put these videos out there to help educate you, and I have the best people on my team who can get you exactly what you need. So if you found this valuable, make sure you subscribe to the channel because I'm constantly researching new ways to optimize your crypto strategy, and I'm only going to share with you the best right here on this channel. So let me know, what's your biggest question about crypto loans? Drop them in the comments and I will answer them personally. And if you want more information about the top DeFi yield opportunities to put your crypto to work for you, then check out Altcoin Pro University through the link in the description below. As always, I'll see you on the next video. I'll also see you at the top. You know what to do. Stay bullish.